this issue of timing is really important. And the only thing that matters in the system that we've created is the short term, right? It's the period, we'll call it 18 months of active duty, right? Where you're not fundraising for the next election and you're not, paying back the favors from the last election, where you actually have some work to do. And you're going to do everything you can as government officials to make sure that people feel good, right? That gasoline prices are low and that spending is high and that people feel comfortable borrowing. And you got to juice when you can juice. And even if you have to pay the piper long term, they're like, well, I don't care about the long term. I won't be here, right? Except some of the career politicians, but then they'll just explain it away.
Borrowing activity in the federal funds market is signaling that stress in the U.S. banking system hasn't fully gone away. Although a decline in total volume suggests the overall need for excess cash has lessened, the spread between what borrowers at the highest percentile of the daily Fed funds distribution have to pay and those below is at its widest since September 2019. That's a sign that some smaller institutions are still having to pay more to borrow cash, according to Bank of America strategists Mark Cabana and Katie Craig. During a news conference, Chairman Jerome Powell said inflation has moderated somewhat since the middle of last year, but hitting the Fed's 2% target has a long way to go. Still, he seemed to leave room to potentially hold rates steady at the Fed's next meeting in September. I would say it's certainly possible that we will raise funds again at the September meeting if the data warranted, said Powell. And I would also say it's possible that we would choose to hold steady, and we're going to be making careful assessments, as I said, meeting by meeting. Powell said the FOMC will be assessing the totality of the incoming data, as well as the implications for economic activity and inflation. Mark Yusko recently shared his views on the recent happenings in the financial landscape, pointing at the interest rates, the key liquidity plays, and what is going on in the broader tech market. Let us now get into the video and listen to what Mark has to say. As you watch, make sure to like the video, subscribe, and drop your comments below.
I will make one caveat. That the FOMC, right, which is not just one guy or gal, but it's, hundreds of very highly educated PhDs,
Right.
on paper, very, very smart, right? And they've been predicting those two things, GDP and inflation, for dozens and dozens of years, right? Here's the crazy stat. This is a crazy stat. They are over on those predictions. Like literally 0 for 286 or whatever it is on the quarterly. It's you could flip a coin and be right half the time. They are horrible at that. So his commitment to say, I don't see, not commitment, but him saying, I don't see any more rate hikes, I'll take that as signal. Him saying no recession and inflation not coming down, noise, right? This is a guy who said inflation is transitory when it was 2% last time, on its way to 7. And now that it's fallen from 7 to 3 and probably heading for sub 2, probably even, I don't know that we'll get all the way back to deflation, but there are some things that are looking pretty ugly. So I don't take his proclamations there with that much seriousness. I really am struggling here because the stuff I see with my eyes, the anecdotal evidence, full restaurants on vacation, full airports, Taylor Swift grossing $1 billion on this tour. The estimates are that she's going to gross $1 billion and set the all-time record. When you look at that anecdotal stuff, it's like, wow. But when you look at other stuff like, credit card debt, multiple expansion, right? Stocks have not gone up because things got better. They didn't go up because earnings went up. They didn't go up because they went up because the multiple went up like a lot. Amazon is selling at over 300 times earnings. NVIDIA is over 200 times earnings. I mean, these are, well, the 300 is actually unprecedented. The 200, we had that with Cisco in 2000, but 300, I didn't know what to say.
The Fed funds rate sets what banks charge each other for overnight lending, but it feeds through many forms of consumer debt such as mortgages, credit cards, and auto and personal loans. The Fed has not been this aggressive with rate hikes since the early 1980s when it also was battling extraordinarily high inflation and a sputtering economy. The news lately on the inflation front has been encouraging. The Consumer Price Index rose 3% on a 12-month basis in June after running at a 9.1% rate a year ago. Consumers also are getting more optimistic about where prices are headed, with the latest University of Michigan sentiment survey pointing to an outlook for a 3.4% pace in the coming year. All of those figures, while well below the worst levels of the current cycle, are running above the Fed's 2% target.
Higher Fed funds actually makes banks more profitable. So, and if banks are more profitable, they can buy more stocks on their balance sheet, even though they're not supposed to, but they do. So that helps with the Ponzi of higher stock prices through multiple expansion. But the point is really, really well taken in that not only is the government fiscal spending really high, and particularly high in the defense sector, shall we say, that it just turns out a lot of our congressmen and senators own stock in these companies that are, they're voting to give money to Ukraine, who then gives it back to U.S. defense companies. In fact, I think it was Mitch McConnell said, you shouldn't worry about us giving money to Ukraine because it's coming right back. That's money laundering. That's not good, Mitch. Don't admit that out loud. But he did. And so that's real, right? That is real government stimulus because those are American companies with American jobs, and people then go out and buy Taylor Swift tickets for $253 on average. Some significantly more than that. But the other piece of it that's gotten lost is M2 ticked up. It ain't going down anymore. No more reducing the balance sheet. The whole, hey, we're going to reduce the balance sheet, quantitative tightening. You haven't heard the word quantitative tightening in months. No one's talking about it because M2 went like this. The bailout of SVB and the bailout of other banks. And look, banks are still failing, but the bottom line is monetary policy is actually expansionary, not contractionary, despite the rhetoric. And so I think those two things, and I think the monetary is important, but I think the fiscal is what's really being lost. 2 trillion is a lot of money. Again, anecdotal evidence says, yes, there is a chasing that occurs. Now normally it's late, like Q4, and that's part of the explanation of Santa Claus rallies, and also around the issue that mutual funds have to sell by October 31st. It's not December 31st. And so there is this downward pressure in mid-October. And then you get this, 30 days later to avoid the wash sale, you get this increase. And then you couple that with a chase year. And that's why you get these big blow off rallies sometimes in Q4. One of the things about summer, right, is people go away. Like literally, I mean, you went away, I went away, people go away. And therefore less happens, volumes drop, and you've seen that in the stock market. You get prone to squeezes. And so, the NVIDIA thing happened, and I've seen it a couple times with other companies that quote unquote made earnings, which we'll talk about in a second. I'm like, no, you didn't make earnings. You told me you're going to make $1. Then you told me you're going to make 50 cents. Then you told me you're going to make a dime, and you made 11 cents, and you call it a beat. That's not a beat. I mean, you told me you were going to make $1 not that long ago. So, but the street thinks it's a beat, and because there's no one in their seats, you get a big squeeze, and they happen. So what I think is actually likely is I think there has been chasing going on. It's just in terms of short covering. People have had to give in. And the number of liquidated shorts this year is an all-time record. It's never been higher. So all that quote unquote cash on the sidelines, I think a lot of it is back in the market already. And yet I do agree with you that there's going to be some people that wake up here and they look and they say, geez, I'm 500 basis points behind. And in the institutional world, 500 basis points is a massive hole because no one said we were going to be up 19% in the S&P this year. Not anybody.
Fed Chair Jay Powell was clear on Wednesday. The Fed's next move has not been decided. Following the central bank's latest rate hike and Powell's press conference, Wall Street economists were fairly evenly divided among those who think we're at the peak for interest rates and those who believe another rate hike will be needed. Michael Gapin and the team at Bank of America, for instance, see the Fed going again in September and raising the Fed funds rate another 0.25%. While it is good news that the disinflation process has continued alongside low unemployment, solid labor market demand, and stronger than expected growth outcomes so far this year, these conditions are likely to keep the Fed worried that its policy stance is insufficiently restrictive, the firm wrote. As for rate cuts, Bank of America sees these coming in 2024. Paul Ashworth, chief North America economist at Capital Economics, in contrast, was resolute in his view that Wednesday marked the final step for the Powell Fed's historic rate hiking campaign. In some ways, the last 18 months of Fed watching has been among the most exciting in decades, with aggressive rate hikes surprising markets and Fed officials trying to adjust their messaging on the fly as the reality of a longer-lasting inflation bout set in last year. But seeing Wall Street economists draw opposite conclusions from essentially the same data returns us to the core of what Fed watching is all about, disagreements that are not categorical, but rather by degrees. Since its start on March 17, Taylor Swift's Eras Tour has taken cities across the country by storm. Now the Federal Reserve has found that Swift's tour is helping boost the economy. The Philadelphia Federal Reserve Office announced that Swift's tour has helped boost hotel revenue in the city. The announcement came in the central bank's Beige Book, which summarizes how different parts of the economy are doing in cities across the U.S. Other cities have recognized Swift's contributions to the economy, including Chicago, whose tourism and marketing organization, Choose Chicago, said Swift's tour run in the city in early June helped set an all-time hotel record. More than 44,000 hotel rooms were used each night of the concert, which ran June 2 to 4, and $39 million was generated in hotel revenue for Chicago, according to Choose Chicago. The organization said other events that weekend, including the James Beard Awards and the ASCO annual meeting, contributed to the number of occupied rooms. Swift recently extended her tour, announcing dates in South America, Asia, Europe, the United Kingdom, Australia, and more. Do you expect the Fed to raise rates one more time this year? Let us know what you think in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.